In this video, traders, we're going to look at tight stops don't work, or do they? Stay tuned. Hey guys, a warm welcome to you. So, the general consensus is tight stops don't work, and I am generally an advocate for that, and I generally say that that's true. Tight stops don't work. You know, 90% of the time, if you're in an environment and you're trying to be really clever and have a tight stop, I mean, it's all relative, obviously, depending on the chart. You have to try and time frame you're trading on: daily, weekly, 1 minute, hourly. But if you're trading with a tight stop, most of the time you're going to have death by 1,000 cuts. You need to kind of have that flexibility of having it far enough away that it's not going to get pinged, but not too far that you're risking money unnecessarily and completely skewing your risk reward ratio. You know, if you can imagine this is 25 pips, okay, that might be just about right. 5 pips is too small, you're going to constantly get pinged out all the time. But if you go 250 pips, you're not going to get stopped out. But when you do, your risk reward ratio is horrible because it's 10 times the amount. You get the idea. So most of the time, I'm going to say that tight stops don't work. However, the point of this video is to point out certain conditions where you can get away with tight stops. I'm going to give you a story about me trading crude oil with very, very tight stops very successfully. So when the conditions are extreme, in other words, you have serious supply-demand imbalance. Talked about this before, and if you like this kind of stuff, by the way, price action, supply-demand, make sure to subscribe. It's got loads of good stuff coming up soon on that. Supply-demand imbalance is hugely out of line, and you've got one-way trade. If you can time it right, then you can use a tight stop. Now, why can you do that? Because the volatility is so high, the moves are so aggressive that you are getting very, very quick shifts in sentiment that if you can jump on, you can have a really tight stop because the moves are very, very quick. They're very, very aggressive, very, very long. And so crude oil, example, when crude oil was coming off those highs and it was hammering down, you know, gold bond had given it a $200 a barrel all these years ago, and it was hammering down. It was aggressive, okay? And you would get aggressive moves to the downside, little pauses, aggressive moves to the downside, little pauses. You'd have 4 or 5 legs of that before you'd have a big snapback because the supply-demand imbalance was so heavily the other way that people were just putting offers on there, like iceberg orders on the book, that kind of stuff. We saw this kind of thing in the flash crash as well. We see it from time to time in equities. It's a nice environment to trade if you can trade it well. You don't need a wide stop in that. You don't need to be saying, well, I'm going to have my stop up here. If you're trading the pure momentum play and your timing is right, you've got something like that flag, then you can use something like a 6 or 7 tick stop. And I know some people are going to go, what, you can't use a 6 or 7 tick stop? Yes, under most conditions you can't. But if you're watching and you're seeing an intraday, of an intraday perspective, then obviously magnify that depending if you're swing trading. But if you see the price has moved, it's stagnated, then you see a specific massive level of resistance, whether that's on the order book, whether that's on your hourly chart or something, and you've got supply-demand imbalance that's so heavy and you see it coming up into this massive level of resistance and it happens to be right there, then you can go right up just above it because you're expecting it to be smashed down again. And so back to this crude oil story, I'd size up my position, I'd go down, and what I would do is I would add to the position every time we broke lower. So I double up, I double up, and double up. And now that would mean that I would have a really hefty position when we're at the lows. Now, 50% of the time, I'd have to, well, my stop would have to come down, I'd have to come down, I forgot to add that point. My stop would come down to lock in that. I wouldn't leave that because the position was so big relative to my expected risk and risk parameters that I couldn't have a stop back up here. That would be, you know, far too excessive. So what I had to do was to drag the stop lower, tighten it up, add to the position, be super aggressive with it. Now, back to the point, 50% of the time, if not more, it will come back and stop me out and it'll be a break-even trade. But because of the conditions, every now and then you get an absolute beauty that will just rip through to the lows. You'd be in big size, comparatively big size, so you'd be sized up on the best positions, and then they'd be scaling out into those lows, and it will be a really successful trade. And so you don't need many of those to make it an absolutely amazing month, amazing quarter for you. So the point is, back to the initial title of the video, guys, tight stops don't work in the majority of conditions, correct? However, if you can find conditions where the markets are active, when they're moving in one direction very, very quickly, they're volatile, you can see an obvious supply-demand imbalance, and you're good at spotting setups that are very, very finite. You can see those turning points, and you know that when it turns, it's just going to go bang. You know, because normal turns, if you say it's a supply demand, like a pivot, a seesaw, you know, it turns like this, right? Supply demand shifts, and then it kind of does this, and then it rolls over like this. When you're in a really aggressive environment, it's bang like this, aggression going down, then it will come back. And if you can spot something where it's about to turn, it won't do this, it will just go back the other way again. So those are the conditions you're looking for. That's when tight stops can work. Very small percentage of the time when you're looking over all the years, the markets do that. But if you're kind of watching equities and you're watching currency pairs, way less in currency pairs, but it does happen from time to time. But if you're looking at commodities, sometimes they have a massive reprice scenario like the crude oil did. Sometimes we actually had in coffee as well. I can't remember what year it was, but we had some coffee rallying off the lows, and there was a massive amount of shorts in it as well. So that caused the same kind of thing where you could trade with tight stops. But if you try and do it the majority of the time, you're death by 1,000 cuts. But in the right conditions, it can work. So just wanted to get that out there for you guys. If you like this kind of stuff, give it a thumbs up. And don't forget, if you like this price action stuff and you like all this digging into bits and pieces and it's up your street and it's the type of trader you are, hit the subscribe button if you haven't yet already. If you have already, I appreciate your subscription. Take care, guys. Bye-bye.